Hi, I'm Brien Lundin with the Gold Newsletter YouTube channel. I have the great pleasure of speaking with a longtime friend of mine, Dan Wilton, President and Director of First Mining, symbol FF on the TSX exchange. Dan, we have talked a lot over the years about First Mining, and it's a kind of a story that's near and dear to my heart because I've experienced some of the biggest winners in this kind of optionality resource bank play in the industry. In particular, in silver, have been I was one of the early investors in Silver Standard. It was a great play. It went on to become SSR, et cetera, et cetera. But it's a proven model for smart investors in smart companies that go in at the bottom of a market cycle and pick up assets that are cheaply valued, that will be richly valued and on the inevitable increase in the cycle. Yeah. And it's a way of getting that market cycle that often works against investors in saying, okay, we're going to let it play for us this time. I think you are the preeminent play in this business model in gold, demonstrated by your asset portfolio. And I know you're just chomping at the bit to tell us all about that. I can see it. Yeah. But you deserve to be proud of it. Let's hear about it.
Well, yeah, and Brian, listen, I think one of the things that differentiates us from just another asset gatherer is that we've actually done a lot of the really hard work to advancing
and not just sitting on your hands and holding the assets.
Where, I think there is a business model out there for buy it at $2 an ounce and ultimately have it trade at 10.
Right.
And in a great bull market, it might trade at 15 to 20 if you're not advancing those projects. You find other people who want to, take on that long-tailed risk. The business we've been in, blessed by that portfolio that Keith Neumeyer really put together in 2015, 2016. We've been concentrating into the two of the biggest projects that we have that we see as real strategic projects.
5 million ounce plus projects in great jurisdictions.
Exactly. One in Ontario, our Springpole Project, which we'll be filing our final environmental assessment document this year.
And that was the key. That's when permitting really is a key catalyst, because that was the knock against Springpole, wasn't it?
Forever, still is. I think still is the reason that it's largely unheld institutionally, is people looked at it in 2010 and said, oh, that's that one under the lake. Well, when you've done
the hard work,
14 years of hard work and all the work on the permitting, we've actually submitted a draft EA in 2022. It's been reviewed by all the regulators. We've got 1,600 comments back. We've responded to those. When they see the final, it's like everyone has done all their homework. We have a very high degree of confidence going in it. But the point I was going to make is, with that and with our Duparquet project, these advanced stage projects, the game that we're in is the, kind of $10 an ounce to $100 to $200 an ounce, right?
And that's in a normal market. That's not a euphoric market. In a normal market, that's what these assets sell for.
That's exactly right. I've been doing this for 30 years as a corporate finance guy and a private equity investor. The benchmarks in my mind are, these projects trade at $50 to $100 an ounce and get taken over at $100 to $200, right? We've seen that time and time again. We're making a concentrated bet on a couple of we think the best projects in our portfolio and moving those forward. And ultimately, how does that value get surfaced? It's probably either through partnership or through project sale, as you expect. But the biggest thing is the industry we all know this, the producers just have not invested in their pipeline. Right? Really since 2011.
Which means they will be desperate to do so when the market heats up again.
That's exactly it. And what a lot of people don't realize is you had 7 major gold projects being built or in the process of being built in Canada right now. Never seen this level of construction activity in the gold sector before. When you get past these ones that are being built right now, you get into this
wasteland.
There's really only a couple that are going to be able to be built between 2026 and 2032. And we know Springpole is one of those. And we think there's a project at Duparquet that we can scope maybe a little bit smaller to start into production and then grow from there, which obviously we've seen a lot of successful projects go that way.
And a key point here is that, yes, the value will increase in when the bull market finally returns, when you get into the upcycle. But major companies are not going to come into a project that still has a lot of hair on it and is not de-risked to some point. So in that you're doing the boring work to de-risk that, but that maximizes the value that a major is going to pay when they come up and write the check.
That is exactly it. We've said forever, when I joined this company 5 years ago, the strategy was we're going to have the best projects in this portfolio ready to go at a time when the industry needs them the most. Right. I've been saying that for 5 years. All the strategic partners have been saying, we don't need to move now. It's going to get cheaper. And you know what? They've been right. For 5 years.
Yeah.
But that is going to turn. We all know that's going to turn. And when it turns, we know how violently that can turn. When you look at, that same period of transition, which was probably 2005 to 2010, 2011 in a silver standard, for example.
Right.
They transition into that kind of producing assets, and that's where you saw the market cap go from,
very considerable multiples in that. And it's a bit outside the scope of our discussion, but we are transitioning from a macro picture from a very harsh rate hiking cycle to a rate cutting cycle. And I think we are in the verge, possibly, and I think likely, for that upswing in the market. Now, we've set the stage here. Why don't we kind of review your assets, which are, really remarkable, not one, but two 5 million ounce plus in great jurisdictions. Let's review for our audience some of the your project portfolio.
Yeah, for sure. So our most advanced project is Springpole, which is a big open pit gold project located about 100 kilometers from Red Lake, Ontario. Submitting our final environmental assessment this year and expecting to have environmental assessment approval by the end of 2025. Big, robust, 5 million ounces equivalent. And one of few projects in the industry that can produce more than 300,000 ounces a year.
Wow.
So the other thing that's important about Springpole and all of the big projects that we have, investors need to remember the leverage that you get on the gold price with these large advanced stage projects. So just for context, we did our PEA on Spring, or our PFS on Spring in 2021. Net present value at a $1,600 gold price of about $1 billion US.
Oh, wow.
Every $100 in the gold price is another $150 million of after-tax NPV, just for context. We'll lose some of that NPV due to capital cost, operating cost, inflation, which we've seen. But if you are an investor that believes in a gold price, to your point about where we're going with rate hikes, rate hikes stopping and rates coming down, if you're a believer in $2,500 gold, $3,000 gold, not only can you buy companies like First Mining now at, sub $10 an ounce, like solid advanced stage ounces in the ground, but the leverage that you get between Springpole and Duparquet just on fundamental value. The NPV leverage for those projects for every $100 of the gold price is $250 million US. Our market cap today is 100 and change Canadian.
Right.
So you're getting basically 3 times our market cap in leverage for every $100 increase in.
That's a good point. Because you just don't have ounces in the ground because you have advanced these projects. You've got economics on them, and you can show the market what that means.
That's right. Economics and that much shortened time frame to a construction decision, to finding a project partner, to an opportunity to see the projects get to cash flow. That's the long tail thing in the industry right now. And so, I think we're in an outstanding position particularly with Springpole and Duparquet. So, we talked about Springpole and, some major catalysts coming there. At Duparquet, we consolidated this project last year. It cost us $10 million in cash and about $15 million worth of our shares to consolidate 100% ownership of a project that has 3.5 million ounces M&I resource and another 2.5 million ounces inferred. 19 kilometers of the Porcupine-Destor Fault, the main controlling structure, literally in the middle of the Abitibi Gold.
So there's some obvious upside to that as well, and majors like to see that as well. Leave a little mystery in it, leave a little upside.
Not only that, but what we're finding now, Brian, we put out some exploration results that show there's a bunch of kind of pods that were separated only because historically they weren't owned by the same company. No drilling in between 2 satellite resources for about 400 meters because this was owned by someone else when our predecessor, Clifton Star, had the Central Duparquet project. We've drilled in the middle at 5 zones of mineralization, all of it classic, Duparquet open grade material. And a lot of those things are only drilled down, the satellite stuff, to about 250 meters. The main Duparquet ore body only goes down about 500 meters.
Yeah.
They mine down 500 meters in the 30s to the 50s, right? And we all know in that part of the world, most
going forever, yeah.
Abitibi don't start until 1,000 meters down.
So is there also a discovery aspect to your story as well as an optionality story?
Absolutely. I mean, I think there's certainly a resource growth, and we think there's resource discovery to be found on the margins of this deposit and at depth, because we've only got a handful of drill holes that go below that 500 meters. But in the first 500 meters in this land package, when you factor in that they've also mined about 1.5 million ounces out of it in the 30s to the 50s, you're talking about, in the first 500 meters, a resource endowment of 7.5 million ounces in 500 meters.
Right.
And is there anything that says that you're not going to have that same kind of mineral endowment going at depth? No.
Now, are you going to chase that, or are you going to leave that to the eventual buyer with deeper pockets to chase that? Is that the mystery you're going to leave in the deposit, or you're trying to prove that up now?
We're trying to demonstrate that it's there.
Yeah.
And I think that's really our target with our exploration campaign. Our team's doing a great job of unlocking where we are going to be able to demonstrate this project is going to grow. But we're not going to be spending tens of
to build a resource
deep drill holes.
So if you get a few holes that show that deep potential, you don't have to get the drill density then to show a resource, because you're going to be selling this project eventually to a very sophisticated buyer who's going to see that and know that this is what these deposits do.
Yeah. With Duparquet, there's also optionality. We have some very high grade material near surface, and we're scoping out potentially
trying to find that
or starter pits.
Yeah,
we've already demonstrated it at the main Duparquet deposit. At Duquesne, we're just doing some scoping work which is on about 15 kilometers down the track, and it's conventional mineralization. Duparquet is refractory, so it needs a flotation circuit. This is traditional Abitibi stuff at Duquesne. But I think in those deposits, like, there definitely is an opportunity for us to see, potential near-term production, in part because we're sitting in the middle of the Abitibi. We've got 10 mills within 150 kilometers of the project.
Yeah.
So we may not need to build our own mill to get started, which would be a huge advantage.
Now, would that be an option for you?
I think so. So we're working on now, and people who own mills don't necessarily want to part with them, but there's a bunch of milling capacity around us sitting basically on care and maintenance rigs.
So one aspect a lot of companies go through is, or entertain, is that if you keep advancing it toward production and show the market or potential buyers that we can always be the buyer ourselves, we just need to keep it and bring it into production. You get the best possible price in a transaction if you have that alternative.
Yeah.
So we covered the two Keystone projects.
Yep.
Each over 5 million ounces total resource. What else do you have? Because you've got a lot more going on as well.
No, for sure. We still have 100% ownership of the Cameron Project, which is 80 kilometers north of Rainy River in Western Ontario. Rainy River is coming to the end of its open pit mine life.
Yeah.
Got a big mill that there'd be lots of capacity potentially to look at that. It's a nice resource, about 500,000 ounces M&I, 500,000 ounces inferred. Lots of work that we'd like to do on Cameron. We've got still right now 49% of Moat Brook in Newfoundland.
Yeah.
Our partner Big Ridge Gold is earning into. Our partner that was Alteco Minerals, now Firefly Minerals, probably spent $40 million.
So you have a couple of JVs going on and work being done by partners as well.
Our partners, if you look at those companies and Treasury Metals, our partners have probably spent $60 or $70 million on advancing that portfolio of projects. So we've owned royalties on them. We've sold those royalties to keep us funded. Yeah. So we don't have to take the dilution for that.
Right.
In total, out of working that asset package, other than our two main projects, we generated more than $50 million worth of proceeds. That meant we didn't have to take share dilution in that.
Well, let's examine that now as we wrap up. What's your cash position, share structure, and what are some key catalysts we can look forward to over the next year?
Yeah, so cash position, we just closed the financing in December, largely supported by existing shareholders, management and board, Keith Newmeyer and myself. The rest of our team contributed more than $2 million of our own cash in a slightly more than $10 million raise. So we ended the year with about 12.5 million, and still lots of work that we need to do this year, particularly on the permitting work at Springpole and moving forward at Duparquet. So share count right now is about 900 million shares. And when you look at key catalysts, obviously submitting our final environmental assessment approval at Springpole, ongoing dialogue with the communities around Springpole, the Indigenous communities, and we'd be delighted if we could move toward agreements with the communities around Springpole. Exploration at Duparquet, where we're demonstrating some of this growth laterally along strike of these existing deposits, and at depth, demonstrating new areas of mineralization at Duparquet.
Yeah.
So lots going on.
Lots going on, as there always has been. So again, First Mining, symbol FF on the TSX, and the key investment argument here is $10 an ounce into the ground or less for assets that in a normal market sell for $100 or more per ounce in there plus. Yeah,
absolutely.
Dan, thanks so much. Great to talk with you. And this is the Gold Newsletter YouTube channel. Please subscribe and listen to more great junior mining company stories. Thank you.
Thanks, Brien.